Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, currency analyst at MUFG. It's Monday, 9th August 2021, and in our preview of the week, we're discussing the key themes for the FX financial markets. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. So good morning, Lee, and what are you expecting to be the main driver for FX markets in the week ahead?
Hi, morning, Una. Yeah, I think in the week ahead, it looks like it's going to be a fairly quiet kind of data calendar and events in the week ahead. The main data releases are the latest CPI report from the US and the second quarter GDP data from the UK. So I don't think those are going to be probably significant enough to really alter the kind of current trends that are in place in the FX market. Obviously, the most recent kind of main event risk that we saw was on Friday of last week when the latest payrolls report was released. And that certainly did show much stronger employment growth in the US for July, with headline employment growth coming in closer to 1 million during the month. Admittedly, that kind of headline figure was somewhat kind of distorted by some kind of favourable seasonal factors, which helped to boost government sector employment to over 200,000 in the month. But I think even if you strip that out, just look at private sector payroll growth, that has been expanding at a much stronger pace in recent months of just over 700,000. And that clearly is, I think, a step up to what we've seen from earlier this year, and does kind of give us more confidence that the labour market is continuing to heal in the US. And obviously for the Fed, I think this is obviously a further step in the right direction. Certainly if we were to continue with this current pace of employment growth going forward, we could be in a situation where all of the kind of post-pandemic job losses could be kind of fully reversed by the first quarter of next year. So it looks like the Fed will be in a position towards the end of this year to say with much more confidence that they have made kind of significant progress towards their policy goals, and just reinforces our view, and I think the market's view, that the Fed is on course to make an announcement on tapering quantitative easing towards the end of this year. Obviously, the fact that payrolls as well was much stronger in July kind of reignites some speculation as well in the very short term that the Fed may even begin to taper QE even earlier, perhaps as soon as September. So I think that is giving the dollar a further boost in the short term. We'll obviously be watching even more closely now in the coming weeks the release of the latest FOMC minutes on the 18th of August, and then obviously the much anticipated speech from Fed Chair Powell at Jackson Hole at the end of this month. I think there's likely to be even more kind of market focus on that speech from Powell now following the payrolls report. So I think in these circumstances, dollar should remain well bid in the short term. We're looking at the kind of year-to-date highs for the dollar index. I think from April, if we were to kind of move closer to those levels and finally break those levels, then the risk of the dollar kind of seeing another lurch higher from here would increase. So that's what we're watching this week.
And what was your main takeaway from the Bank of England's latest policy meeting, Lee?
Yeah, I think it was an interesting meeting. We were somewhat surprised that the Bank of England kind of explicitly introduced into their forward guidance that they're now planning on some modest tightening going forward. Admittedly, obviously the emphasis there is on modest. We're not expecting a significant amount of rate hikes anytime soon from the Bank of England, but it is obviously just another kind of step towards the Bank of England towards tightening policy, and that obviously reflects kind of growing confidence at the Bank of England in the outlook for the recovery here in the UK. They're becoming much more confident that a stronger recovery will continue in the coming years, looking for growth this year of just over 7%, and then even next year looking for growth of around 6%. So that obviously would be very, very strong growth if that was to materialise, and that would give the Bank of England justification to start to tighten policy going forward. Obviously, as well, we watched closely as well the release of the latest inflation forecasts. Obviously, the Bank of England did acknowledge that the overshoot for inflation in the near term is likely to be more protracted or pronounced than they had previously anticipated. So they're now showing kind of headline inflation rising up towards kind of 4% peak kind of later this year, early next year, before kind of falling back towards their 2% target over a kind of 2 to 3 year time horizon. So still not overly concerned that this is going to be a persistent inflation overshoot, but certainly becoming more concerned that this may be something which lasts longer than they had initially anticipated, and that as well as encouraging them to think about scaling back the loose policy that's in place. And I think importantly as well, if you look at those inflation projections, that those were based on the assumption that market rates are currently pricing in about 50 basis points of tightening over the forecast horizon. So that gives you a kind of an indication of what the Bank of England is thinking in terms of modest tightening going forward. So about kind of 50 basis points of tightening. And the market was also pricing in the first rate hike coming around the third quarter of next year. So that as well is also an indication of when we could see the first rate hike from the Bank of England. We've been kind of penciling in the first hike next year in August. We're still sticking with that forecast, but after the update last week, we do think there's some more risk that the Bank of England may actually start to raise rates sooner than the summer of next year. So I think that in the short term, that's obviously helping to support the pound and could lead to some further pound strength. But the one kind of offsetting factor which has helped to kind of dampen pound gains on the back of the updated forward guidance from the Bank of England was the details that we got over the Bank of England's latest plans for policy sequencing. They've basically announced that they've lowered the threshold to start quantitative tightening. By that I mean reducing the size of their balance sheet. Previously, they said that they wouldn't start to do that until the bank rate had been raised to up to 1.5%. But now they're saying that they'll start to consider reducing the balance sheet by not reinvesting the proceeds of their gilt holdings as soon as the Bank of England rate rises to 0.5%, so about 1 percentage point lower than the previous threshold. And then once the bank rate, if that continues to rise up towards 1%, then the Bank of England will also start to consider whether they need to kind of more actively reduce the size of their balance sheet through outright gilt sales. So I think for the market, the reaction has been kind of understandable. The market has kind of moved to price out some further rate hikes further out in the future from, say, late 2023 onwards. And that's based on the view that if they do start to reduce the size of their balance sheet through quantitative tightening, that's seen as somewhat of a substitute to tightening through rate hikes. So if they go down the quantitative tightening route earlier, then that may mean that there's not as much need for the Bank of England to continue to raise rates beyond that point once those thresholds have been met. So I think further out the curve, that has, like I said, helped to dampen the expectations for further rate hikes. So yes, overall, Bank of England looks like it's going to start to raise rates sooner, which is pound positive, but the actual scale of this rate hike cycle may be kind of more modest than the market had been kind of previously anticipating. So that is helping to ease upside risks for the pound.
Thanks very much for sharing your insight, Lee. Have a great week, and we'll speak to you soon.
Great. No, good to speak to you as well. Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.